Hello and welcome to a brand new episode of your favorite weekend show, Smart Money. Now with the markets once again less than 3% away from all-time highs and earnings season now almost behind us, we speak to Gautam Duggad, Head of Research at Motilal Oswal, on how you should approach the market now, how valuations are stacked up, and whether India is still a preferred bet in the emerging market space. Gautam, thank you so much for being with us here in the studio. You know, that is our, that's the perennial problem, right? I mean, it's a good problem to have. Markets almost at all-time highs. Should I get in now? Should I be a bit cautious? But at this juncture, just to set the tone, how are you feeling about the market?
So, Sonia, market has been good, but it's been led by earnings. When we say markets are at all-time high, we forget that earnings are also at all-time high. Let me give you a data point. NSE 500 profit pool 3 years back was 5 lakh crores. We ended FY23 at 11 lakh crores. So that's about 28% CAGR. And NSE 500 market cap CAGR is 31%. Even for Nifty, the 3-year profit CAGR is 22% and a market cap CAGR is somewhere about 27%. So while markets are at all-time high, the corporate earnings are also at all-time high. The GDP is at a new high. And next 2 years also we are looking at around 15-16% kind of a corporate earnings CAGR. So market over a period of time has broadly respected the underlying corporate earnings, give or take few percentage points or few months here or there. When the markets were flattish for almost 7-8 years, so FY14 to FY20, if you look at the earnings compounding, it is hardly 5-6%. And markets also gave you similar sort of a compounding. So over a long period of time, broadly the market has respected the underlying corporate earnings, and that is where we are seeing a lot of buoyancy. Even this quarter as we speak is about to come to an end in a few days. The earnings have been ahead of expectations for any set of aggregates. You take Nifty, you take our broader coverage universe, X this, X OMC, any sort of aggregate you look at, the earnings have been better than estimates, and we have seen a marginal earnings upgrade now. So while markets have done well, it's led by earnings, and valuations in my view for large cap at least is still very reasonable.
So earnings are generally the bedrock of every bull market rally, right? And it's been good, you said. You said the profit pool of the Nifty has gone up from 5 lakh crores 5 years ago to 11 lakh crores right
3
now.
years, that is for NSE 500. 5 to 11 lakh crores.
Okay, so we're sitting at 11 lakh crores in terms of a profit pool right now for NSE 500. How much do you think it can go up by, say over the next 2 to 3 years? What are you looking at? And which are the sectors that can lead it up?
So, Sonia, our estimate for Nifty for next 2 years is a CAGR of about 17%, which is basically distributed like this. FY24 we are expecting a 20% earnings CAGR and FY25 about 15% growth. So that basically sums up 16-17% growth. It will be led by 2-3 very important domestic cyclical sectors. One is financials, which already had a very stellar run in terms of profitability over the last 5 years, and profits have been up 5 times in 5 years. Over the next 2 years, in financials profit pool, we are expecting about 20% compounding. Auto, we are expecting to almost double the profit pool in the next 2 years. And then we have consumer and pharma growing somewhere about 14-16% and IT at about 10-12%. So these are the basic large contribution of the index sectors which are driving the earnings over the next 2 years. Where we find earnings slightly subdued is in the global cyclical stack, because that is where the global growth is still a bit shaky. Commodity prices have still not come back to their earlier highs, and for those sectors the underlying commodity prices matter more. Whereas in domestic cyclical and say defensives, which form roughly 65-70% of the total profit pool, we think the underlying macros as well as the overall environment on demand front is picking up quite well, and we expect it to sustain.
Okay, I want to talk a little bit more about the macros and the micros, but at the end of the day, all of this boils down to valuations as well, right? Now, what's your view? How are the valuations stacked up now compared to our own historic averages and also compared to our global peers? Because there is one narrative that China is now looking more attractive than India, so money could move into China. You don't buy that argument?
No, I don't buy that argument, Sonia, because 10 years back also China looked attractive. Look at the returns. 10 years compounding for MSCI emerging market is flat. MSCI China is marginally flat to negative, whereas India is given about 11% CAGR despite being expensive to begin with. 5 years compounding, MSCI China again negative, MSCI emerging market flattish to negative, India about 10% compounding. In fact, if you look at the last 2, 3, 5 years performance, Indian markets have been amongst the best performers. I'm not looking at CY23 YTD because some of the other markets which had fallen in CY22, they've rebounded. So India is not right there at the top of the league in CY23. But if you look at the last 2 years of compounding, 3 years, 5 years, 10 years, we're right up there. Even on a 10-year basis, barring I think S&P 500, most of the markets have lagged India. So I don't buy that argument because India has always been expensive for a reason. Right? Our corporate earnings are very different than the rest of the markets. Our ROEs are picking up. And there is a good macro policy momentum in our support. As far as valuations are concerned, I think Nifty is bang in line with long period average right now. We're trading at about 19.5, 20 band. 3 months later, you will start looking at FY25, where the valuations will become even more supportive at about 17.5 to 18 times. Right? So from a large cap point of view, Nifty point of view, I don't think valuations are giving you any scare. The real problem is in mid cap and small cap, in pockets of mid cap, small cap. So mid cap at an index level is now trading at a premium, and small cap is still at a discount. But within small cap index, the constituents where there is a lot of interest, those stocks are obviously trading at a much higher premium versus their historical past. So there are pockets where valuations has really gone up. So stock prices have doubled, tripled. For example, in industrials, I was looking at the data. 3 years back, the top 100 industrials company of India had a combined market cap of 7 lakh crores. Today, it is 21 lakh crores. And if you look at the same data for companies below 25,000 crore market cap, the market caps have gone up 5, 6, 10 times. Right? So a lot of the buoyancy in earnings is more than factored in some pockets of the market, especially mid caps and small caps.
Absolutely. I take that point completely. Especially, I mean, look at spaces like defense, right?
Yeah.
The kind of up move that these stocks have seen, 100%, 200% in the last 1 year or so. So let's talk about that. Which are the sectors that you like where there is an upcycle after a long lull period, right?
Yeah.
Because we've spoken about that ad nauseum. There's autos, there's real estate. These sectors have come back after a very long sort of dead period. But where is there both valuation and growth potential now?
So as far as cyclicality is concerned, there are 5 sectors where the upcycle is happening after a very long time, as you rightly mentioned. Look at real estate. After 10 years, the sector has started breathing again. Second, you look at auto. For 5 years, the profit went nowhere. Between, say, FY18 to FY23, the profit pool of auto was flat. When banking profit pool went to 5x. And now we're expecting auto profit pool to double. 3 quarters in a row, we have seen earnings upgrade in auto. In fact, in this quarter also, the best performing sector is auto, where we have seen by and large upgrades across our coverage universe in auto. Then I would look at something like hotels. That sector has also had seen a very long stagnation. For 10 years, the EBITDA of Indian hotels was almost flat from FY8 to 18 or FY19. But now we are looking at 35% margin for companies like Indian Hotels. And other companies in the hotel space are also doing quite well. Similarly, you have sectors like, say, hospitals. I don't know when was the last time there was a cycle in hospitals. And suddenly there are too many options to play in that sector where earnings are coming up thick and fast. So basically, broadly, all the domestic cyclical oriented sectors, financials, everyone knows and everyone talks about it endlessly. But then there are other smaller sectors which are relatively lesser weighted index. They are having their own mini upcycle right now.
Okay.
Industrials, we already spoke about how the profits and order books are growing. But in that case, you've seen market caps already jumping multiple times in the last 2-3 years.
So you spoke about autos, you spoke about real estate coming back after a long time, hotel companies as well. Here, what do? Do you stick to the large cap guys because all of these stocks have rallied substantially, whether it's M&M, Tata Motors, Indian Hotels, or do you now find value beneath the surface, right? I mean, in the broader markets. And if yes, what are the 2 or 3 top ideas here in these sectors that are coming back after a long time?
So Sonia, there is no compulsion to stick to any particular market cap segment. You have to stick to a company where their visibility of earnings growth is strong. So be it small cap, mid cap or large cap, it doesn't matter. For example, in automobiles or autocom, we started covering Craftsman about 6-7 months back. The stock is up 40-50% from there. But next 2 years, we are looking at compounding earnings of 35% plus. So P is still 20 times. There are many such ideas. In fact, we are big time overweight on auto. We have large caps like M&M also in our model portfolio. We have mid caps like Ashok Leyland, Bharat Forge also, and small caps like Craftsman also. Similarly, consumer discretionary, it's a big ocean of sectors there. It subsumes many subsectors. You have hotels, you have footwear, apparel, jewelry. We have a huge overweight right now going on consumption in our model portfolio. So we have Metro, we have Titan, Indian Hotels we spoke about, Kajaria Ceramics, Zomato we had added a month and a half back. We are positive selectively on QSR space also. So after financials, I would think our biggest overweight right now is in consumption, and within that consumer discretionary. The only sectors we are right now neutralish is IT and pharma, and underweight on global cyclicals. Otherwise financials, and within that our preference is towards NBFCs. So financials, consumption, auto and select industrials is where broadly my overweight positions are concentrated in model portfolio.
You know, I want to talk to you about financials because that's a space that has been under pressure. Since July, the index, the Nifty Bank is down almost 4%. But what we're going to do is we're going to take a quick commercial break and come back with lots more on smart money. Do stay tuned in. Welcome back. You're still watching Smart Money on CNBC TV18. We have with us Gautam Duggad, Head of Research Institutional Equities at Motilal Oswal Financial Services. And we're here to talk about India continuing to be one of the best stories amongst the global peers and one of the sectors that you should be buying. Gautam, before I ask you about banks where there is pressure, it's interesting to see that this global market rally has been far more pronounced than India this year, right? I mean, this year the Nifty is up 8%, but the S&P 500 is up 16%. So in that context, is there a catch-up that India has to do compared to its global peers?
No, honestly, Sonia, when you look at 8-9 months of a return, you are not looking at what happened in CY22.
Yeah.
CY22 Indian markets were flat, whereas rest of the global markets corrected. That's why I said if you look at 2 years CAGR, India is the best performing market globally. 3 years, we are the best performing markets globally again. 5 years second best and 10 years second best. So I wouldn't read too much into 7-8 months of a performance or underperformance. It's sure fact that rest of the markets are coming back from their lows, while we have basically consolidated and grown 8-10%. Our mid cap and small cap indices have grown 20-25%, which have come back into reckoning after almost 4-5 years. So I won't read much into the underperformance of 8 months because it is coming on the back of a very strong performance over the previous 2-3 years.
Absolutely. Okay. Let's talk about some sectors then and stocks as well. Before the break, I was asking you how banks have underperformed, right? What do you think the key reason for that is? Is it only margin moderation and earnings coming off, or is there, a story that the market is pricing in future?
I think there are two reasons. One is the profit moderation, which is largely a function of what is happening to the margins. So margins picked off in 4Q FY23 for banks. 1Q FY24, we've already seen 15-20 basis point of a shrinkage. And most of the managements have guided for another 10-50 basis point of NIM compression. So when we look at the next 3 quarters of earnings for our coverage companies, because we have a visibility of next 3 quarters which we break the full year into 4 quarters right at the beginning of the year. So first quarter we looked at private banks, we were expecting a 31% growth, whereas they've delivered 36. But this 31% growth which we were expecting in first quarter goes down to 12% for fourth quarter. So there is a moderation every subsequent quarter, which is a reflection of NIM compression plus the best of the asset quality for private banks now being in the base. Similarly for PSU banks, first quarter we were expecting about 96% growth. They've done about 130%. But the fourth quarter our expectation is just about 10%. Right? So the growth is moderating. Second problem is of ownership. Right? So banks are there in everyone's portfolio. Unless there is a significant positive catalyst which is not well known, I don't think a significant rally coming up in banks, because this is not a small sector which is underowned. This is a biggest sector actually in the index, which is well owned. So in financials, what we are looking at is, since April when the RBI first put a pause on its monetary policy tightening, the trade shifted in favor of NBFCs because they had underperformed earlier. Now you look at the last 3-4 months of performance, NBFCs have done really well and their valuations were also quite attractive. On top of that, their asset quality, AUM, disbursement growth and their guidance for the next 2 years on asset quality and growth is pretty strong. So that is where we increased our weight in model portfolio away from banks towards NBFCs.
Okay.
And that is what the trade I think will be for the rest of the year in my view for banks.
Okay, so that's on banks. A couple of other key sectors that moved, right, in the past week, in the past month. One of them is these platform companies. So we noticed in this quarter's earnings, Zomato, Paytm, PB Fintech, Delivery, all did pretty well operationally. And Zomato's one call that you had taken, I think, at 50 rupees. Now it's almost double since then. Is it too late to jump onto this one, or do you think there's more to go?
So I would say that in this kind of companies, it's always very difficult to predict what can happen because the listing history is very limited. Plus their profitability history is still not established. So they're going to be very volatile. At 160 for Zomato a year and a half back, everything looked perfect. It came down to what, 50, 45? We initiated just 3 months back at a price of about 54, and we recently introduced it in model portfolio, but I think 70, 75 rupees. Our expectation was that for the next couple of quarters, the operating profit or operating loss that they've been reporting will shrink. We also didn't expect that they will report a PAT level profit in this quarter. So there is a surprise every quarter. Sometimes on the downside, sometimes on the upside. So you have to maneuver that portfolio very differently compared to other sectors where you have a lot of cyclical history, how management behaved in the earlier cycle. In this particular case, you don't have any history of how the managements and companies behaved in earlier cycles. So you have to take it every quarter and reevaluate the thesis on numbers.
Like
so
a little bit of trial and error.
Absolutely,
Yeah?
absolutely.
Okay. Another space which has done phenomenally well and a lot of retail investors have missed out is defense, right? Today we were speaking with Baba Kalyani and he said that the defense vertical will contribute 10% of their overall business by the end of FY24 itself, and he's looking to double their revenues by FY25. And these are stocks which are already at lifetime highs. But do you see this as a structural upcycle?
Yeah, Sonia, but what has happened is the appreciation in the market cap in defense segment, not just Bharat Forge, I'm talking about in general PSUs, because that is where the maximum money has been made in the last 2-3 years. Markets cap have gone up by 5, 6, 7 times. Order books have grown, profits have grown, valuation re-rating has happened. So if somebody is a fresh entrant in this space at this price, at this valuation and market cap, he or she has to be very cautious, because you're not entering an unexplored sector now. This is the talk of the town, which has already done very well. So your expectations have to be very moderate. Incidentally, Bharat Forge is a part of our model portfolio, which reported very strong set of numbers, and we have seen a marginal 3-4% earnings upgrade in our estimates for FY25. But for the space as a whole, I think a lot of money has already been met. From here, any stock that you want to enter, you have to be doubly sure on what you're projecting for numbers and how you expect valuations to look like in the next couple of years, because do remember, this is also a function of the policy from the government side, and that always induces its own volatility.
Okay, just 2 quick questions before we end the show. One is, what are the big risks in the market now? Because, there are some risks on the horizon, whether it's crude, which is at a 9-month high, there's a general election coming up. In your mind, what are the risks?
So Sonia, risk is always more from things which you are not able to predict right now. If anything you are able to predict as a risk, it means the market is well aware of that. So crude has always been a risk for India, whether at 100 or 50 or 60, because when it is at 50, 60, you always expect it might go up. If it is at 100, you expect it might go 120. So crude is a very generic risk for India and is a very relevant risk. But aside of that, I think as we move closer to the election cycle, because now the general elections are hardly 8-9 months away.
Yeah.
So that will have a very important implications for the market, because if the results are not to the market's liking, possibly there will be a lot of volatility. If it is to market's liking, then you will see the momentum continue. So that is one important risk I would think, apart from the usual global risk on rates, inflation, commodity. Those are pretty well known. I don't think market will sort of react very strongly to those kind of risks, because there's a lot of money lying on the sidelines which is waiting to enter India. Okay. A lot of new avenues of money from different markets of the world which is entering India. You've seen money coming in through markets like Japan, Korea, Asia Pac. We've seen that reflected in the FI flows already. And I think December 21 to February 23, you had seen about $16-17 billion of outflows. That has been recouped in the last 5 months. So to put it other way, since December 21 to now August 23, the FI flows have been zero. Whereas the domestic flows have been somewhere about $54-55 billion.
Oh, wow.
So
Okay,
there is a lot of capital waiting to enter.
There is a lot of capital. Okay, got that. Gautam, before we let you go, one final question, because there are a lot of young investors that are coming into the markets now, and with your, I think, over 2 decades of experience, what is the one piece of advice you'd like to give an investor who's just starting his investment journey?
I think it's a very standard advice, Sonia. I mean, what has worked in the market is patience, discipline, and time in the market, which is what all the investing greats have been writing about since many decades. Second, the biggest risk in the market that you ask is not being in the market, right? Last 10 years, your profits have compounded 13-14%. Markets have also compounded 14-15%. And that's how the journey of market has been. If you are able to enter at the lows of the market, whenever there is a crisis, your compounding goes up by 3-4 percentage points. If you enter right at the peak or at the euphoria when everyone is talking about it, maybe your compounding is 10-12%. But the biggest risk, I think, for any youngster is not investing in the market, because the earlier you invest, the larger the time frame for your capital to compound, and that's a very, very important thing, because compounding is what has created the biggest wealth in India.
Okay, that's some really sane advice, Gautam. As always, thank you so much for joining us. It was the most informative half an hour that we could pack in for our viewers. With that, it's a wrap on this edition of Smart Money. Thanks a lot for watching. Keep writing to us. We love receiving feedback from you. Have a great weekend.